A lot of people across the globe have been on the hunt to get into a few of the best dividend stocks available to invest in this world. Dividend stocks have been historically outperformed by the S&P 500. One of the best things about them is the low volatility they come up with. So, what is the big deal about them? How does this kind of investment make it easier for you to earn better profits? And how do you go about it? Stay tuned and we will get to you with all of the details you need to learn about dividend stocks. Welcome back everyone to another video here on your favorite channel. We are here to learn more about the best ways to make some passive income. So stick with us till the end. Hit the like button and subscribe to this channel to keep learning more about ways to make passive income. But keep in mind that dividend stocks are also a bit risky, so you should make sure you invest after a good analysis. So let's get started. A dividend is essentially the distribution of a company's profits to shareholders. The dividends are distributed on a quarterly basis and are considered one of the best ways to make a good profit out of your investments. So, how do you figure out the amount you may get out of an investment? Let us understand this with an example. Assume you buy a total of 100 shares in Company A. Each of the shares you bought was $10 each. Let's assume that A pays a dividend of $0.30 annually per share of stock. As a year passes by, this will mean that based on the 100 shares you bought, you will be receiving around $30 in dividend payments. This is how the dividend system works. Now, how you make use of this money that you make through dividends is something that you can figure out on your own. This depends from person to person. A lot of investors may choose to reinvest it into the company, while a few may take out the profit. The dividend stocks provide a total of two sources of income. The first one is the regular income from dividend payments, and the second one is capital appreciation. Let us have a look at how you make an investment and how you make a good profit out of it. The first of the ways we will be looking at is the dividend yield. So essentially, this is an annualized dividend that is being represented as a percentage of the stock price. If you feel it's a bit too complicated for you to understand, allow us to simplify this with an example. If a company pays a total of $1 annually as dividends and the stock costs a total of $20 per share, then the percentage here would be 5%, which is called the dividend yield. Yield is an important metric as it helps you compare the current levels to the historical marks that it has been at. Now, even though having a high yield is a very good thing, a company being able to maintain it and gradually being able to increase it every year is a more promising indication that will call for higher investments in it. The next important term is the cash dividend payout ratio. This is a term that relates to the dividend as a percentage of a company's operating cash flows minus the capital expenditure. Now, just like this one, we have a long list of other terms that will help you get around it. We will not get into the details as our objective today is to make the most amount of money through dividend stocks. Keep in mind that high yield is not the only thing you should look into. There are a lot of other factors, and if you tend to look only into this particular aspect, that would be an action coming out of one's inexperience. So make sure you take a few other things into consideration. Keep in mind that even though it is good for the high yield, there are chances that the high yield being shown is a result of the stock's price falling due to the risk of dividends being cut. This is called a dividend trap. So first of all, let us have a look at a few ways that could keep you out of a yield trap. The first way is to avoid buying stocks based only on the dividend yield. As we mentioned earlier, a higher yield may not mean a good thing coming ahead. It may have a very bad repercussion in disguise of a good future. So be aware of that. The second way is to use the payout ratios to measure the dividend sustainability. A sustainable dividend will help you grow gradually and will help you make a significant profit in the long term. Make sure you study the balance sheets of the company you will be investing in. It is important for you to study debt, cash, and other important assets and liabilities while you do so. These ways will definitely help you get through the objective of making a good return on your investments. Now, while we are here, you also need to have a thorough understanding of the taxation system and therefore find out the best ways to pay taxes without you having to overpay them. Keep in mind that in most cases, the dividend stocks paid are qualified dividends which are generally lower than your tax brackets. These are generally taxed at a lower rate, which is 0 to 20% of the total amount you earned. This range is much lower than the income tax rates of 10 to 37%, which are generally charged. An additional 3.8% tax is also levied on certain investments, but only for the high earners. So, if you are paying any more than what has been prescribed here, you may be overdoing it. Keep in mind that even if you are investing in MLPs, you may have to pay taxes to your IRA, so make sure you double-check your status every financial year. Paying dividends is obligatory for companies. This means that you may not get a lot of dividends in a few companies which do not feel the need to do so. The dividends could be at risk if the company decides not to make additional expenses in a said month. So, when you choose a company for dividends, make sure you choose them after due diligence and after understanding the corporate structure really well. So this means that you cannot completely get rid of dividend cuts, but it is something you can always avoid losing by taking some evasive actions. As we mentioned earlier, a lot of people do prefer reinvesting the money they get from the dividends. This is called the DRIP, which stands for Dividends Reinvesting Plan. There are no fees or commissions charged here, and the benefit here is that you get more shares of this company. All you need to do is start with the DRIP system, and it will automatically keep accumulating your stock holdings, which will further increase your portfolio's value as the company grows naturally. If you are deeply interested in making a bit more money passively, you could make use of the dividend-focused exchange-traded fund, which is abbreviated as the ETF. Mutual funds are also a very good option available for the investors, which will enable you to diversify your portfolio and make the most out of the investments you make. All of these strategies will help you make a very good investment in the long run. As time passes, you will be able to make a really good amount of money passively, where once invested, all you need to do is wait. If you do not wish to use the DRIP system, it is completely okay, as you will then get the dividend amount back to your account without any further issues. So if you are planning on making use of the dividend stocks and getting a good income out of it passively, make sure you keep an eye out for one of the most important metrics here, that is the yield. You will be able to make a better decision if you invest in stocks that have a higher yield and will certainly be able to work wonders in the long term. Even though we do call it an important metric, we would never call it to be the go-to metric. This is because yields can often be misleading. As we mentioned earlier, you need to have a look at other vitals, such as the balance sheets and their historical progress. If you are not clear with that, watch this video again from the part where we explain the concept of yield, and we are sure you will be able to make very good progress with earning money passively through dividend stocks. The price you pay for one share of the company may vary. So, yield values tend to change with time, as it is calculated by taking into consideration the price of a single share of the company. The yield value may also increase if the stock price decreases, which is the one thing you need to look out for. So, while you make an investment and the yield is high, do realize that it could also be because of a fall in the stock prices. That's about it for today. We will meet you again with more interesting videos and concepts. Hit the like button and subscribe to this channel to keep us encouraged. Until we meet again, keep investing and earning.